elevation. We hunt and we hungry, we celebrating, turning nothing to something and celebrating. Market's changing, we calibrating. The first to get acclimated is the first to stack the payments, but you need to act with patience, but be careful waiting, cause this opportunity won't last forever before it is evaporated. So if you wanna flip some houses, hit me up to make a plan. Your flip deserves the upper hand.
Hey everybody, welcome back to another episode of Raising the Flipping Bar. I'm your host, Derek Marlin, and I'm excited to have Mr. Rick Stubblefield in the house. Resident Wizard is Rick's moniker because Rick does everything with our team from transaction management, manages our hedge funds and institutions, and is a rock star agent on the team. So Rick, welcome to the show.
Thank you. So the moniker, the Wizard, was bestowed upon me, oh goodness, 10 years or so ago.
Yep.
And I think, the team that I was working with at the time had a team lead who was called the Machine.
Nice.
Because she was just constantly at the grindstone, working the leads, making things happen.
Yeah.
And so when the team got together, one of the meetings, I don't even remember who it was, but somebody said, well, if Allie's the Machine, if she's the one that's, driving the cogs and everything else, we've got Rick who solves all the problems. He should be our wizard. And so that's sort of as a problem solver. That's where I was named the Wizard by my colleagues.
I love it. And we were talking off camera, and I think this is good context for the audience too, which is you and I, and definitely me, is a statistics person, because I think data is important, but we're going to throw out a lot of numbers. We're going to talk probably more numbers than most people do, but we're not going to get in the weeds because I think people lose sight of good business decision making. So we'll be somewhere in the middle of not just like total gut feel and just winging it and being very ethereal and things feeling right. But we're also not going to be like complete statisticians, because I think I worked really hard to get like a B- anyways. Like I'm not that qualified, but you and I were talking about that.
I mean, talking about B- in statistics, the one thing I took away from that class was the margin of error makes everything kind of fungible. So yeah, if you get too caught up in the weeds of stats, it's analysis by paralysis, right? You're not gonna actually take the actions, the steps you need to take. If you kind of have a general understanding of the abstract of what's going on in markets, then you can be more open to finding those opportunities. And don't get me wrong, the numbers definitely are important, but that's sort of like the piece, that's the last piece, right? You're doing your analysis based off of more macro conditions. That last piece will be what makes you the 3 to 5% extra on the back end.
Yeah, and I think that's really why we're going to kind of coin this type of episode, and we'll have you back on at least a quarterly basis, is instead of market predictions, it's market movers. What are the things moving the market? And then everybody can use those things to help kind of customize for their, running their business.
Yeah, sounds good.
So let's dive into today's episode. What I want to talk a little bit about and set the stage for you guys listening and watching this on YouTube is we're going to compare this year of September 2025, because that's the most recent data we have. This is coming out in October. We're going to look at a year ago, September 2024. We're going to talk here pretty deep into why we're quote unquote skipping COVID, because I think that was it was beautiful and it was fun and it was profitable, but it was an anomaly. So we're going to actually jump to 2019. And I think people will be very interested to see like, okay, the sky isn't falling. It's not easy. It's hard in this market. But that's what we're going to talk about. So what I would love for you to do is maybe give the viewership and the audience a little bit of detail of really where you focus at Elevation, what you're seeing from a hedge fund perspective, because that's insight other people don't have. And then we can dive more into the numbers, but just give them kind of your focus and some of the hedge fund takeaways right now.
Yeah, sure. So as part of the Elevation team, my role is helping everything get through from contracts to closings. And so what we're seeing in that realm is that buyers are feeling a little more emboldened right now, right? So whereas maybe in years past, they knew that they were competing against 10 other offers and they would have to come to the table with, 10% over asking price and waive all of their rights throughout that process. Now they're willing to step out on some limbs. And in even some cases, if they don't get what they want, they're more willing to walk away because they feel like they've got a little more of an upper hand. And I would agree that there's some normalization that's been going on in the marketplace. It's no longer, the sellers are going to get 20 offers in that first weekend. Maybe they'll get one or two. Maybe they don't. The average days on market is actually up to about 40 days on market, which is considered historically to be fairly normal. If you compare that to 2019, it's pretty much right on track with where we were before COVID. The pre-COVID. And then if you go back even further, like to 2008, The days on market was, almost double that. So we're still in a pretty good position for the normalization there. On the hedge fund side of things, we're seeing that our institutional sellers are looking at sort of the metrics of either option, either continuing to hold and rent versus selling. And they're not committed to one approach or the other. So what they're doing is they're asking us to look at any given asset class, any given property, and then provide our expertise, what we think the market's going to bear for that property. And then they're going to make that decision whether or not it's worth taking the step of trying to exit out of it or just go back on the market and rent it again. Most of the properties that have been presented to us have actually gone to market. When they do, the pricing is all over the board, right? We provide our recommendations based on what we see, and they're either going to take it or not. But in some cases, they're going to come in higher than we recommend. In some cases, they've come in lower than we recommend. So they have their own metrics that they're looking at too. And what we're finding is, if it's priced too high, it's going to get overlooked from the beginning, and then it's going to get stigmatized real fast. Yeah. Looks like stale inventory, especially when the buyers have so many more properties to look at. So that's sort of the macro, from what we're seeing with the institutional sellers. And then, at the end of that 3 to 5 month period of time, when they try to sell a property, they don't sell it. They're just pulling it back off and renting it again, which is very similar to what your regular mom and pop homeowners are doing.
Yeah. Well said. Yeah, and I'll kind of bookend that information with what we're seeing you guys from a flip perspective. And we're seeing a little bit of a tale of two cities. We had a batch of properties that we just got done doing and selling off, and they were in the lower price points. Median home price or slightly above median home price around in the $700,000 range. And those took a while, and those took price concessions. And we had one that we started at $775, and we just closed it last week, and it was $695. So not great. We had two other smaller ones that were in the $500 and the low $500,000 range, and those went quicker in about a 30-day time period, but there were also still concessions there. So we're seeing that stress in the market of first-time home buyers. They're sensitive to interest rates. They're sensitive to job loss. They're obviously asking for concessions. Conversely, I just didn't have the money on hand. Maybe if anybody wants to JV with me, I could have kept them, but we wholesaled some expensive ones to clients. And those are between $1 million and $2 million sales price points. And those are just coming off the shelf right now. We just did one for a client, shout out to Jordan, and he crushed it. And we sold it just under 1.4 million. And so those more expensive ones are doing really well.
They are. They're not impacted by some of the same factors, right? So when you are talking about the lower price points, those buyers are very interest rate sensitive. At the higher price points, you would think it's counterintuitive to think that, if someone's going to be buying a house for $1 million, that they would be less sensitive to the interest rates than someone who's buying one for 400,000. Yeah. But the reality is that those people have investments. Mm-hmm. Those people have, a broader view of those conditions. And so, and some of them are putting down significant amounts of money or even paying cash. Yep. And so when you're at that higher price point, a little further in your careers, a little further in your lives, your investment portfolio, everything all together, knowing that you're going to pay maybe 1% or 2% higher on the money that you're borrowing isn't that big of a deal when you can, instead of taking cash to buy that property, you're borrowing at 6%. And then keeping your money working for you in the markets and making 10%. Yeah. So, it's they have more flexibility. And so that market really hasn't been as impacted as we would have expected.
Yeah. And maybe I'm kind of jumping all around my notes, but I'd love to hear your take because I know you're an investment person yourself and you follow the market. I think you're right. Those higher price point folks are less sensitive to interest rates. What do you think that the stock market psychology does to those people? Because I feel like we're a little inversely related, and it sounds silly, but if the stock market doesn't keep going to infinity like it's seemingly doing now, then interest rates come down and then our lives get a little easier over here. But what do you think about kind of stock market sentiment versus housing sentiment? Especially for those higher net worth.
I mean, I think it's a simple term to describe it. It's recency bias. Mm-hmm. And anyone can be guilty of this, yep. Right? So if you're, a paycheck to paycheck, young family or, multi-job, homeowner, and you've got to work hard just to make ends meet because of the inflation that we've been seeing over the last few years. Your recency bias is very negative, yeah. Right? It's focused on just trying to get by. And so these interest rates seem very significant, these changes. Conversely, when you're talking about, that $1 million plus home buyer, Those folks, their recency bias is I've been killing it in the stock market. I've been killing it in crypto. My property values haven't been tanking. Everything's great.
Mhm.
So an extra couple of percent is less concerning. And it's all just about perspective of the market. And that's why, every investor is going to tell you diversify your portfolio. Right? Because if you can diversify your portfolio when one market is tanking and the other one is going to be booming and vice versa. So you're never going to have that sky is falling doom and gloom perspective.
Yeah, no, that's really well said. Well, and maybe let's take our audience through kind of, I'm going to call it the how we got here, meaning we'll talk about 2019, we'll talk about where we're going right now, but I want to give you guys kind of this context because COVID screwed things up. And I know that's an understatement because there's obviously the health component, and I know that was tragic for a lot of people. But I want to focus more on the housing and the economic side of things. And so before COVID, we had this kind of nice, steady increase and rise through 2019. And then COVID happened, and we had a roughly 2.5 to 3 year period where things were insane. You want to kind of give the audience a little bit of a reason why that happened, of inventory and kind of what happened in those 3 years, and then we'll talk more about like what's going on now.
Sure. Yeah. Well, so first of all, one of the reasons that I, am called the wizard by my colleagues is I've been doing this a long time.
Yeah.
Right. I got my license in 2001. I've been working full time in real estate since then. During 2008, during the bubble and the financial crisis, I was a traditional real estate agent. I was doing buyer and seller listing appointments, buyer appointments, selling homes. So I worked through that period of time.
Okay.
And I hear a lot of people today talking about the correlation between now and then. But again, it's recency bias.
Yes.
Because they're nothing alike.
I totally agree.
The reality is what we're looking at right now is very much alike with what was occurring right before the COVID pandemic. And so when the COVID pandemic hit, the things that the government did were intent upon keeping people safe and also not crushing the economy as a result of it. So the knee-jerk reaction is shut everything down, right? And so markets across the country, states across the country just shut everything down.
Yeah.
They were sending people home. You couldn't go to work. And it's not because you couldn't find a job. You weren't allowed to work. So they started to supplement that by allowing people to take loans for no cost or zero, next to zero costs.
Yep.
And they dropped interest rates to next to zero to allow people to leverage their assets easier to survive that time period.
Mm-hmm.
What ended up happening is you had a bunch of people that were sitting at home with not a whole lot to do besides thinking about their homes and saying, do we want to be here? Is it now the time to make a move? Should we improve remodel the kitchen? Like, what are we going to do with our time? And a lot of those, Zillow warriors started looking at real estate and thinking, okay, well, gosh, if rates are this low, we might as well make that move we were wanting to make for so long, or we might as well borrow some money against our house and improve it. And so we saw a lot of extra money flowing into the real estate market and people that had more time. And so that led to significant competition increase. So you got lower cost to borrow and higher competition. And so that just was like the Wild West.
Yeah.
To your point, it was very profitable for people that do what we do with the investment space. But it was also very good for just your typical homeowners, buyers and sellers. Buyers had to overpay. But the thing is that the properties kept up, right? The supply and demand kept driving those values up. Now we have a problem because of that, because of affordability. But with respect to how the markets look compared from then until now, it's like we had this frenzy. It was like, the throwing chum in the water, in a Shark Week episode, right? The sharks go nuts and then the chum's gone and they just kind of whatever, goes back to normal. And that's what we're seeing right now.
Yeah. And I think inventory was a key driver there too, because it was so low. I remember seeing data that I thought was wrong, where granted it's seasonally adjusted, meaning in the winter and over the holidays, typically there's the least amount of homes for sale, not rocket science there. But I saw in January of 2020 that we had less than 1,000 homes for sale, detached and attached at every single price point.
Sure.
So to your point, we literally had 10 buyers for every one property, and that's why it was crazy.
Yeah.
And now we're just slowly swinging back.
Well, and what's crazier is what you just said was at one point we had 1,000 homes in 2020. In 2019, just the year before, we had 4.5 months worth of inventory active in the market. So that's a huge change, and there was an obvious catalyst that resulted in that change. But you're talking about 4.5 months of inventory. Comparatively speaking, that's where we're at right now.
Yeah.
Right. So we've just kind of worked through all of that and come back to the mean. But also, again, compared to 2008, back when I was really having to fight hard and struggle at every turn. Inventory was 9 months.
Right.
So, a lot of, again, the recency biases over the last few years, it's been crazy. There have been, 10 buyers for every house that's for sale. And, the prices are going nuts and everything is super exciting. And now all of a sudden prices are, well, not actually depressed. They've just kind of year over year, our prices are stable from last year. We haven't seen losses, but that may not be accounting for those concessions you were talking about as well, the 1% to 3%. But nevertheless, it's not a huge change in value.
Yeah.
What's changed is perspective.
Yeah, and I think you bring up a good point, and I think that's what, and we're getting to where we're at right now. But that middle of 2022 through, roughly, so probably 2 to 2.5 year period, they have it. They call it the lock-in effect, meaning interest rates shot back up very rapidly, and so there was a big proportion of people that had low rates and they didn't have a need to move, and prices were increasing, and so that's when the transactional volume came down a little bit. So maybe just give people like that next 2 year, 2 to 3 year window of like, things just kind of came to a halt. And now I feel like we're kind of coming out the other side.
Yeah, no, and that's a great point. So one of the statistics that I've heard is that when homes are sitting on the market after 2 to 3 months, half of the homeowners, 50%, are taking their houses off the market rather than reducing the prices.
Yeah. Wow.
So what that's telling you is that these people are confident in the value of their assets and they don't have an urgent need to move.
Mm-hmm.
Okay. So, if you compare that to, for example, 2008, it was the opposite. People had very high loan to value ratios, which means that the loan that they had taken out to buy the house was 100%, sometimes 103%. The normal loan back then was a 103% FHA.
It's insane.
Insane, right?
Yeah.
And then also, we didn't have appraisals that were, independently operated from the transaction.
Ooh, interesting. I forgot about that.
So when we get a contract that came in at 103% of our list price, the very first thing that I would do as a real estate agent is I would call my favorite appraiser and I'd say, hey, I just got a contract on this property in Littleton and this is our sale price. Do you think you can get that for us on the appraisal? And if he said, yeah, I can do that, great, go take a look.
Yeah,
if he said, I don't know, it's going to be tight, it'd be like, okay, well, I'm going to call another guy. And so you'd call somebody until you got the yes.
Yeah.
And that's just how business was done, right? It wasn't, nobody thought anything, unethical was going on. But the reality is that everyone was colluding to support these huge loan amounts. But that created a situation where homeowners did not have the equity position to be able to take the hits or to wait. And if they lost a job, they couldn't make that mortgage payment and they had nothing to fall back on.
Right.
So we had a lot of foreclosures.
Yeah.
Right now, as far as the foreclosures go, compared to that, we are, it's night and day. We're down 25% from just 2019.
Right.
Compared to, 2008, I've heard somewhere in the 70% range, if I'm not mistaken.
Yeah.
So again, my point being, what you were saying is that homeowners have had the option of saying, do I want to reduce the price? Do I need to move? Or do I just want to wait until next year because I think conditions are going to be better? And half the people are doing that.
Yeah.
So what that means is that over the next few months, I think especially for our audience, our investors, our flippers, our landlords, being ready to go and nimble and fast to act is what's going to make the biggest difference. Because you've got a lot of buyers that are just kind of sitting on the fence and they know that the affordability is out of their range. But if the rates come down, all of a sudden it gets a little bit more affordable. Or the other thing that the government's talking about doing, 40-year amortization loan.
Yeah, definitely.
Right?
About that.
So if they extend out the loan amortization, then the payment's going to go down. And let's be honest, your average home buyer is not looking at purchasing a home based on the price. They're looking at based on their payment. And so if the payment goes down and they can get into the home they want to, they're going to come off the fence and get into the game. And there's a lot of people that are waiting to do that. A lot of first-time home buyers that just can't get in right now. But if things change and if it's a combination of the two, 40-year amortization and interest rates go down, we're going to see small frenzies. We're going to see, short bursts of action. And so for our investors and the flippers out there and the wholesalers and people that are looking for rental properties and just good investments. We're going to continue to see values increasing because those are going to spur that activity. But at the same time, if you're nimble and if you're ready to go, then when those market changes happen, you can A, take advantage of it yourself, and also at the same time, B, beat the competition off the fence.
Yeah, and I think that's really, really well said. And that's something I would really give our audience guidance and advice. And we can't, of course, dictate when we sell, because if not, we'd sell immediately. But we're, again, to frame this from a timing perspective, we're coming out of September into October, and we just got done selling 3 of our properties as a company. And one went well, one went not so great, and one was a train wreck. And then a lot of our client properties went really, really well. But I'm happy, and it goes back to my favorite term, which is the velocity of money, meaning I want money back in the bank. I want cash in the bank right now. And then I think over the next 12 months, and our investors should think, what can we do in the next 12 months to take advantage of those opportunities? Because they're going to be there. I mean, I think if people looked at it and said, and they ask us, when's the best opportunity? Classically, it's buying in the winter and it's selling in the spring/summer. And that's where we're at now. So I think people need to, like, just to your point, recency bias, like dust that off, throw that away. Don't throw caution to the wind. We'll talk about numbers here in a second, but I think it's really important. So well said.
Yeah.
Okay, so let's talk a little bit about some of the data. I know you looked at a few things. Let's maybe re-hit just for a hot second the foreclosure information.
Okay.
Because I think it's simple clickbait. I call it. There was some creative term that I had, but it's too early and I haven't had enough coffee. But it's essentially the person at a seminar, that always from the back yells, "Well, what about foreclosures?" And my response is always like, there aren't those foreclosures,
Yep.
to your point, especially compared to back to 2008. But if you have any data, and I've got a couple points, but just give them a frame of reference of foreclosures, because it's just, again, it's such clickbait. And we got to look at the data that they're not there, and we don't see them going up on a nominal basis, meaning from 100 to 200. But that's a quote unquote 100% increase in foreclosures. So it's like the whole clickbait statistics.
Well, that's a great point, right?
Yeah.
When you work the statistics, if you go from record lows to still pretty low, that could be 100% increase. So the statistics might actually say you've got 100% increase in foreclosures, but really in historical context, it's not that much, right? So that means even more when you say that foreclosures are down 25% from 2019, right? We're still down 25% from then. And that is taking into account some of those statistic anomalies. Yeah, it's very consistent, and it all boils back down to the exact same metrics that we were talking about. There's the homeowners have got more equity, they've got fewer defaults, less stress, and then that creates fewer distressed inventory. There's also we've got financial cushions. So, for example, in 2008, someone loses a job, they've got 103% loan. They're turning the keys back in. That was something that people were doing. They would just put keys in an envelope and send it back to their lender and say, "Here you go."
Yep. Yeah. Take it off my hands.
I can't even deal with the process.
Yeah.
Just take it. But now, maybe they go and they get a line of credit and leverage it against the house because they've got so much equity. They've got an interest rate 5 years ago at 2-3%, and it's just been accruing equity since then. Our values are still growing. We've still got very stable value proposition. So from that perspective, not a lot has changed. But in talking about some opportunities for our investors, the one segment that does have a little bit of an oversaturation and some flexibility in some of the perks that they can offer is the new construction segment.
Good point.
So right now, builder supply, I just said that our supply in the residential market is 4.5 months. Builder supply is 9.5 months.
Oh, wow. Yeah.
And they have, the financial backing to be able to provide some incentives, right? The typical builder transaction, they're going to do like a buy down, a 3-1 buy down on that interest rate, or potentially just a permanent buy down, depending on, what works best for their borrowers, their buyers. Sometimes they don't offer that for investors. So it's going to be case by case. But as that inventory, continues to sit, and if rates do improve, that's their competitive advantage right now. That's going to balance out. That's going to create some good opportunities for investors to get a good product that they don't have to worry about. Just get it rented and away you go. So I think that's an interesting little segment to look at.
No, I think that's really good. And I want to bring up a couple of data points, and then we'll use that to frame more recommendations. Because to me, it's what's moving the market. We're not smart enough to be crystal balls or complete Nostradamus, but let's put this into context. So I'm looking at some of my data, and If I look at 2025, again, we're comparing September to September. Our median home price right now, which think back to your statistics class, it's not the average because again, we could have a $200,000 condo and a $12 million property. That's the average. The median is where you're at with the distribution curve. So our median is 589 closed price, which is only off a 0.5%. So again, level, nothing going down crazy. The active listings, this is both single family homes and attached, meaning condos and townhomes. So this is everything. It's just over 13,000 active listings. For last month to this month, it's only up 0.1%. So we're leveling off. We're not continuing to skyrocket with more properties coming on the market. I think the kicker, and that you and I were talking about off camera, is the transactional volume is just down. And so just in our industry, people's, paychecks and people's checking accounts, it's down. I mean, we only had 3,366 sales for the month of September. That is down 8%. So that one is tough. And now we're entering that second year, but technically it's actually higher than 2024. So looking at 24, we had 3,092 sales. That compared to the prior year, that was down 19%. So technically we're up a little, but we're not up a lot. And then, we can talk about 2019 here in a second, but median days on market is 35 right now. Last year was 25. So to your point, things are sitting for a bit longer, but I don't know if there's any other data points that stick out to you of last year versus this year, and then we'll hit 2019.
Yeah. So, I mean, it's really interesting. Some of the things that you were pointing out, right? I mean, when you're talking about the percentage of sales change year over year, a lot of the headlines that we're hearing are talking about like, oh my gosh, there's so many houses on the market, sellers market, all that stuff. But in doing some of my research, the inventory year over year is only up 34%. Right? And it's not nothing, right?
Yeah.
That's meaningful, but it's
Right.
it's only 34% compared to what you're hearing on the news, right? It sounds like we've got record highs.
Yeah.
But we really don't.
Yep.
New listings year over year were up 5%. So that also tells us that things have been sitting longer, right? The average days on market, I think you just addressed that, that has increased by about 15 days.
Yep.
On average per month, or I'm sorry, per property. And the median sale price is flat. And then, as I was talking about earlier, in our market, only about 38% have had price reductions. So the national average might be 50%. We're only at 38%.
Right.
So that lends to sort of the stable year over year values.
Yeah, and I think to me, it's almost like think about the eye test. To your point, I got in the market in 2009, and I was a buyer. So luckily, I saw the sky falling, and I had some money and scraped everything we could together. Even borrowed some from my father-in-law. Most people think that's a terrible idea, but it ended up working out really well. And bought all the rentals that we could. And you saw for sale signs everywhere. It's just a good old fashioned like, damn, I drive down my neighbor's street or my street, and there's tons of for sale signs. Then we had oh my gosh, did anybody ever sell their house? And there's no signs in the yard. So you'd say, well, those are new neighbors and it's sold off market. And now you see a handful of signs, so it's almost like we can overanalyze data, but if you just use the eye test, you're like, okay, that seems pretty good. Nothing crazy.
Absolutely.
Let's frame 2019 and then let's get to some of the 2026 recommendations. So I have down that in 2019, again, as of September, the median home price was $483. So obviously that is a big jump. And I think that hits your affordability challenge that we're in right now. But here's the 3 data points that I'm going to throw out to you guys. And then would love to kind of hear your thoughts on this, Rick, is in September of 19, there were 9,286 active listings. So to your point, not nothing. Yes, we are up, roughly a third. So that's a lot, but it's not ending the world. New listings, I was really surprised at this. There were just over 6,700 new listings compared to new listings now, which was this year at 4,900. So we actually had more new stuff coming on in September in 19 than we do right now. We obviously had more sales. We had 4,500 sales. So that's where, again, people's commissions are getting hit. You're like, oh, I was doing better in 19. Yeah, you definitely were. And then the big kicker that has increased is we were only at 2.1 months of inventory. And to your point earlier, we're close to 4. So stuff is sitting. So it's just that it's what does it feel like versus what is it? And that, yes, we are doing less deals. Houses are taking longer to sell, but it's not the sky is falling above 8.
Yeah. I mean, we've we've sort of gone over a lot of those cause and
Mhm.
effect changes. But the truth is that, to your point, it's not a significant difference from just before the pandemic. One of the things that you did mention, regarding agents, like, this is where a paycheck comes from. Fewer closings means
Mhm.
fewer dollars in my pocket. And that is true. However, over the last year, and I don't have a statistic on it, but
Mhm.
I know that it's a significant change. A lot of agents have left the industry.
Yeah, well said.
It's gotten hard. Transactions are down. On the aggregate are about the same, but the gross has reduced based on volume reduction. But this distributed among fewer agents.
True.
Those agents that are out there working, finding those deals, banging the pavement. It's not that significant, and some of them are actually really profiting off of this because we have new tools now that we can use to leverage and create more time and efficiency through the automation.
Yeah, that's really well said, and that's something that I love being at Elevation and creating this investment-driven machine that we're working on, and I really commend the agents that are doing it more traditionally. Because 'cause you're right, if you are just banking on the regular home seller that's taking 10 years to sell their house and moving along, that's fine, but our people are doing better. We're working with hedge funds and selling properties, we're flipping properties, people are buying rentals, they are still getting the, traditional transactional business, so our folks are doing better, and I think they're poised to do a lot better here in the next
Yeah.
year or 2. So I'm glad you said
'Cause
that with less
right
competition.
now we're taking the time to establish the framework that's going to be, the basis of success going forward.
Yeah, absolutely. So as we kind of wind down on the last segment of the show, would love to hit on anything else that you have in your notes of keys for success, tools, things that people should be thinking about
Mhm.
and focusing on as we look towards 2026 in the overarching investment world.
Yeah. So just sort of to reiterate, what we've already gone over, I think it's important to be ready and to be nimble. I think it's also important to look for some of those small niches, like, for example, the new constructions.
Mhm.
That's not going to help our flippers, right?
Yeah. Yeah.
Unless you find a builder that's has so much over inventory, they've just got core and shell house in place and they haven't finished it out yet and they're ready to sell it off. That
Yeah.
might be an interesting
Right.
avenue to keep an eye on. If a builder needs to get out of one community and into the next, and they
True.
just want to be done with it, potentially you could have a chance to pick up 2 or 3 properties that still need to be finished out
Yeah.
and realize the gains from that with the crews and the process that you're already used to.
Said.
Aside from that, I think that 2026 is probably going to be pretty fruitful, especially again, recency bias,
Yep.
considering the last 18 months, the struggle that it's been at these rates that went up, to your point, almost overnight,
Yeah.
right? I mean, it happened fast and it had to, right? Inflation was out of control. That was the way to sort of reel that back in.
Yeah.
One thing that I would maybe suggest that our audience consider, especially if you're doing flipping, if you're doing wholesaling, we still don't know if there's actually going to be any impact from the tariffs.
Yeah. Well said.
Right. When the tariffs first went into place and they were tariffing everybody, and they had the big chart of all the countries and
Yeah.
whatever else, right? The sky was falling. The next day, the stock market was going to tank, right? Well, it didn't. And then half of these countries came to the table and made a bunch of deals. And then those others that were walked back for a little while. And so I think most of the market believes that that's more of a negotiating tactic than an actual policy implementation, but it remains to be seen. And so if that's going to have an impact on building supplies and building materials, looking for an opportunity to sort of stockpile
Yeah.
and warehouse some things could be a good leverage point for 2026. Um, I also know that in a straw poll of Fed members, the members of the Fed, something like 21 bank presidents or whatever,
Yeah.
from across the country, is almost split down the middle, half and half. Half of them in the straw poll felt like there'd be 2 rate reductions before the end of the year.
Mhm.
The other half felt like there would be 4 rate reductions by the end of the year. So we've had one, and it was decent. And I would expect maybe 1, possibly 2 more before the end of the year.
Yep.
Probably less meaningful, like eighth of a point,
Yep.
nominal adjustments. But anytime you do that, you're going to see some excitement. And then I do believe that getting into next year, the start of next year, there's going to be a strong push for some more significant changes for affordability. And so again, just as investors, we just got to keep our eyes on it. And the second we see something like that where we can benefit from it personally, go find an opportunity to use that tool. Because otherwise, you're going to have fewer opportunities because you're competing against more and more people.
Yeah, and I think the only thing that I would add to that, and I think that was perfect analysis, is kind of getting back to basics. And one of the absolute kings of neighborhood by neighborhood analysis was Lon Welsh over at Your Castle. And I think that's super, super important is looking at neighborhoods and looking at cities. And so don't get sucked in to thinking that parts of Aurora are quote unquote cheap now, but you potentially do have a lot of other inventory for sale. You've got a lot of competition and it's where do people want to live versus we just looked at a house yesterday off market in Arvada and people are still moving to Arvada. There's still great schools. There's a lot of good things going on there. So you just got to be really, really kind of very localized and not just across the board that, oh, these are great deals. The deal has to be by neighborhood, which is again, it's 101 level investing, but we can't get away from those types of things.
Mm-mm.
You know, so I think that's super important.
Yep. And something that we've talked about off camera recently as well is when you're doing these flips, when you're actually taking the time, you get the opportunity, you put the effort into a property, you have to expect A, it's going to sit a little bit longer,
Yep.
but B, you need to be the best product.
Yes.
Because if you want to take 45 days of potential holding time and keep it there instead of becoming 60 or 80 days of holding time, which time is money when
Yep.
you've got a hard money loan against the
Yeah.
property, you need to be positioned to be the best option available so that when you do hit, you're going to sell faster than the competition, as fast as you possibly can in this market.
Yeah, absolutely. And I think the only thing that I'd add to that too is just have reserves. So you can weather that storm. I think that negotiation tactic is obviously helpful. If to your point earlier, you can walk away. I think that's where some of those homeowners have had that great upper hand is they just say, you know what, I don't need to move. I'm not in foreclosure. I'm not underwater. Haven't had that life event yet. Be nice to move, but no big deal. So as investors, I think we have to do the same thing. You got to have cash reserves so that you can not hit the panic button. But to your point, you got to have the 10 out of 10 level finish or else it's probably going to sit. So well said. Awesome. Well, as we wrap up, I really appreciate you being our guest today,
Sure.
Rick. This has been awesome. You guys at home, definitely check the show notes. We're going to have a lot of extra data, a lot of different reports that we'll look back. We'll get the wizard back in here for our market movers updates. And we've got a couple spots left for our Elevation Academy coming up on the 14th of November. So give us a DM. We've got a $100 off promo for anybody listening to the podcast. You can just use podcast. But man, Rick, thanks for joining us.
I've been through the Academy twice now. And in all candor, the tools that we were provided in the Academy in our last flip, we didn't use those tools. And I greatly regret it. Like that's, we've been struggling with the disposition on a flip that we've done. And had we used the tools that the Academy provides, I'm confident none of that would have happened. But one more thing before we go,
Yeah,
I'd like
totally.
to add.
Yeah.
Just this last week, ChatGPT announced that they're starting to create or give users the ability to create their own agents, their own AI agents.
Yes.
And one of the tools that they are implementing for use in these agent automations is they've partnered with Zillow. And so I don't know exactly what that means yet. But for those investors out there, if you're looking for that extra little thing that might keep you ahead of the competition, get on Zillow or get on ChatGPT, start playing with its integration with Zillow, and it creates some automations to give you daily updates. And maybe you can use that as an opportunity to try and target those homeowners that have sat on the market for more than the median. Because if they've sat, maybe 90 days plus, those are likely the people that have a real need to sell.
Yep.
Okay. Now, Zillow doesn't give you the best metrics as far as like pricing and, for comp research and things like that, but they can find opportunities. And so if you can figure out ways to, create the chatbot or not the chatbot, the automated agent.
Yeah, the agent.
In ChatGPT utilizing Zillow to get you daily automatic opportunities to consider. I mean, that should help.
Yeah, you guys definitely go back, rewind that, and listen to what Rick just said. I knew we would go down that rabbit hole. We'll have a whole nother episode on that. Rick and I both really nerd out on the use of AI in our real estate investing businesses, but use that integration with chat and Zillow. I think it's going to be a game changer. So we'll totally have a new episode coming up on the use of AI in the real estate investment business. But you guys go back, listen to that. That was the perfect parting shots. Rick, man, thank you so much for being on the podcast. We appreciate you guys listening, and we'll catch you guys on the flip side.
Elevation. Flip that house, man, this money for the making. We gon' get it, hustle harder every day, fam. Sky's the limit, time to make